The IRS says changes are coming, and if you want to avoid delays or costly mistakes in 2026, you'll want to start preparing now. The IRS is urging Americans to start preparing now for the 2026 tax filing season. While the official filing window is still months away, new adjustments and documentation requirements could affect how much you owe or receive, especially if you wait until the last minute. Several inflation-related adjustments are taking effect for the 2026 tax year. These include updates to tax brackets, deductions, and required forms. While no single change is dramatic on its own, together they could affect how your return is calculated and processed. Here's what the IRS wants you to know before tax season begins. One of the biggest updates involves federal income tax brackets. Tax rates themselves are staying the same, but the income thresholds for each bracket are increasing. That means more of your income could be taxed at lower rates, especially if your wages have not kept pace with inflation. For example, the 22% tax bracket for single filers will apply to income over $50,400 in 2026, up from $48,475 in 2025. If your income stays about the same, that shift alone could slightly reduce what you owe. All the other tax brackets are shifting as well, for both individuals and married couples filing jointly. The standard deduction is also going up for 2026. Married filing jointly will see their standard deduction rise to $32,200, up from $31,500. Single filers and those married filing separately will see the standard deduction increase to $16,100, up from $15,750. Heads of household will have a standard deduction of $24,150, up from $23,625. This could reduce your taxable income if you don't itemize deductions, potentially resulting in a smaller tax bill. To avoid delays, the IRS recommends waiting to file until you've received all necessary documents. Missing forms or incorrect numbers can delay refunds and trigger errors. Key documents include W-2s from your employer, income statements like 1099-Ks, 1099-MISC or other forms for gig work, 1099-INT forms for interest income, and 1099s from banks or investment accounts. You'll also need Form 1095A if you have marketplace health insurance. Records of digital asset transactions are required as well. And do not forget any IRS letters or CP01A Identity Protection PIN notices. Additionally, some tax-related records should be kept permanently. The IRS refers to these as forever documents. These include birth, death, and marriage certificates. Divorce decrees, adoption records, and Social Security cards should also be kept indefinitely. Estate or gift tax records are important to retain, and diplomas or certifications tied to legal or financial matters should never be discarded. Misplacing these documents could create legal or financial headaches later. To reduce tax season stress, the IRS recommends several steps you can take right now. First, create an IRS online account. With an account, you can view your tax history, balances, and payments, and access your identity protection PIN to help prevent delays. Next, set up direct deposit. Electronic refunds arrive faster than paper checks, but only if your bank information is up to date. Finally, review last year's tax return. Changes like new dependents, income shifts, or updated deductions could mean different paperwork or filing strategies this year. The bottom line is that the IRS is signaling that early preparation will be key for the 2026 tax season. Changes to tax brackets and deductions, along with evolving documentation rules, could influence your refund or tax bill. Getting organized now may help reduce errors, avoid unnecessary delays, and put you in a better position to file with confidence when the time comes.